Frank Trotter is an executive vice president of EverBank and chairman of EverBank Global Markets, EverBank's family of investing alternatives, and was a founding member of the original EverBank.com. He has 35 years of experience in the banking industry, and I caught up with Mr. Trotter at the Sprott Natural Resource Symposium in Vancouver. And welcome back. I'm here now with Frank Trotter. He's the Executive Vice President of EverBank, founding member as well. Frank, thanks a lot for joining me once again.
Love to be here. Thanks.
So you had an interesting talk to kick off the symposium where you went through a lot of things that you're basically seeing, in banking and also in America. And one slide that stood out was, and I can't say I fully understood the graph because I should have taken a picture of it, but basically you looked at factors that affect margin growth. And one, as you would expect, would be capital, which was the biggest one. The second factor was lobbying, regulation, and that sort of thing. What exactly did you measure in that graph?
Well, it was based off an article from Boston University, an academic put together, and the real question he was trying to ask was, this was from 1971 to 2013, how have corporate margins increased over that period of time? And I think we all have this feeling in the back of our mind that more and more of this is done in crony sort of political business, or what the economists sometimes call rent-seeking activity. And the thing about rent-seeking activity, you go back to the French court, and the king would be able to say, you can collect rents on everybody in Rouen. And so you'd go to court, you'd lobby, you'd be a nice courtier for the king, and so you get rent-seeking activity. Today we sort of feel that way, and what this is attempting to measure, and what the academic found, was that the order of margin expansion, which is better business, you think efficiency, research and development, new products, new markets would be the real answer. But what he found was capital was first, and what he called crony and legislation and lobbying and regulations that prevented other people from getting into your markets was actually second in margin expansion. And I think we all feel it from time to time. I did show a slide that at least I always get a kick out of. I don't know if anybody else does. It's a West Texas four-way stop in the middle of nowhere. There's not a chance you won't see the car coming down the other road. And I think we counted 12 flashing red lights and 4 stop signs. And I just have to think that the city manager's brother-in-law was the sign company. That's kind of a minor example, but you go all the way up to the defense industry. We know, for example, that the newest fighter plane, literally the entire chiefs of staff are in the Pentagon said we don't want. But Congress pushed it through. And so this margin expansion, this crony capitalism, has expanded radically, apparently, since 2000, this academic found. And I find that particularly interesting, a little troubling, because that doesn't allow the economy to expand at a rate we'd like to see it. It doesn't allow the other businesses and employment to expand. And maybe we're going to try to look at it further, and you follow this down to the fact that median income in the United States is now below the level of 1995 in real terms. So it all sort of bundled together, and it was a concern. Doesn't mean we're going to fall apart, but just this is where the business is going. It's better to lobby government than it is to go out and create a new product.
Yeah, and regarding that West Texas observation, tumbleweeds don't obey traffic signals, so it's not really doing anything.
Keep right going, don't they? Keep on tumbling through.
You're going to have lots of accidents there anyway. And if you take it one step further, I don't know if this gentleman was an economist or he's educated in finance, but if you just look at the capital portion of it, if you consider the artificially low funding costs that the biggest companies enjoy,
right,
then it's all to do with politics and regulation.
Right.
If you could fund your operations at almost 0%, whereas the little guy, doesn't have the same funding, access to funding, then that's basically just another giant subsidy, isn't it?
I think it is. It's certainly a subsidy for government. That's number one. You look at the interest cost to all the governments worldwide has changed radically. As the slide that followed that showed, that stock buybacks, often done with borrowed capital at very low interest rates, have become a predominant factor in the market today. Something, I don't recall the number off the top of my head, 151 billion in the last couple months. That's a large number, and it shows that companies don't feel that they have a great new idea that they want to invest capital in, so they buy their stocks back, and of course that affects the executives' options and personal compensation as well.
On the one hand, buybacks make sense when, say, you have a company like Apple who is actually stockpiling, just generating tons of cash with no real high margin projects. But there's another thing to sort of re-lever the balance sheet that way, using it strictly as financial energy. Is that party over? Is the bond market kind of fatigued, tired of funding this activity? What do you see happening?
I think that the markets will continue to lend to good companies at low rates. It's an additional spread over treasuries. Some people, institutional managers in particular, have to buy fixed income. That's just what they do. And so if you get a little better spread at an appropriate credit level, whatever your personal tendencies are there, you do buy it. And so certain companies certainly will be locked out of the market very appropriately. But at these rates, as you point out, compounding at 1.x% for 50 years doesn't get you very far.
You had another slide, which is funny, because I don't know if you realize that some people refer to people in banking as banksters.
Yes.
So you had a slide that said where their real body is buried, and you were talking about where the inflation is. And it was interesting for me to see someone in the industry just as kind of not confused, but it boils down to excess reserves, doesn't it? That basically there's lots of state money, but the commercial banking system is not really acting, levering it up. What would it take for that to happen? Because this is the big debate, right? Are they going to bleed these off, or is something going to happen? And I kind of see it as like accumulating flammable gas. It could just go up, and it's like, what would it take for the banks to lever up on that and get fully loaned up again?
Well, and I think the issue that you point out is in 2008 the state money, which is really the Federal Reserve, was only about 5% of total money supply, and it's expanded radically. And I think many of us thought that this would create inflation in the near term. You probably hear 2 or 3 other speeches today that would suggest it's imminent. But banks have actually had issued less bank money over that period of time, making it a very slow money supply growth. And I think there's a number of things. Obviously, banks have had to have additional capital, so you can't lend as much on the same balance sheet. That's number one. Obviously, we've seen a lot of change in regulation in terms of lending, mortgage lending in particular, but restraints by regulators and boards on other lending. And I think there is the part where banks could lend more and you could start to see the multiplier go up is if they begin to have confidence in businesses and individuals. I think many banks sit back there and say, it's an interesting idea, but we really don't want to take the risk on that. It's just we're not so sure. And as long as we have this huge uncertainty in the market about economic growth, banks won't tend to lend as much to people and companies. And I think that sort of interacts with the stock buybacks a little bit. Apple has all this wonderful cash, but they don't have the next great product, or they don't have the confidence to invest in the next great product. Let's take it down to a lot of other manufacturing companies just aren't building that next factory. And that's where they would need to borrow money. That's where you get the money, the multiplier, the velocity of money going up. The Fed certainly believes in their hearts, and we've talked to a couple of the members directly, they think that if this occurs, that they'll be able to take the Federal Reserve balance sheet down effectively by selling the stuff back into the market and taking cash out of the system. Remains to be seen. But that's really how you could accelerate the money supply growth, create potential inflation or hyperinflation if it occurred. But I think to get it going, you just need more lending.
You think it's mostly the banks pushing back on that, or is it because I know your regulators like to sniff around in your loan books, take a look at what's going on? How much of it is it them, say, by, I guess, taking the carrot away or penalizing you for not having enough capital, and how much is it just prudent banking saying this is not a good economy to live
Well,
in?
I hope it's prudent banking. I know that's the way we approach things. I think there are two pieces to it. I think the prudent banking part is I don't really believe in that project yet. I'm uncertain about your ability to pay me back. There are significant new regulations that will slow the creation of lending, particularly mortgage. If you had a mortgage before the crisis and a mortgage today, it's a radically different experience. We think it's actually good. It actually makes it a level playing field because we actually followed most of those rules prior to the crisis. But that slows it down. There are other regulatory issues that slow it down. You really don't want to get into this business. We'd really prefer you not. But I think it's just the core uncertainty in the market and the core uncertainty by business that has slowed it down. And until that confidence comes back, watch the consumer confidence numbers. They're not that high. They're increasing, but they're not off scale. So as that comes back, then perhaps you can see the door open again.
There seems to be a kind of a long-running trend, and that is, and you're going to hate me saying this, but banks being managed into utilities gradually. We had Hillary Clinton with a quote recently that says, it would be a good idea for the Postal Service to get into this business by taking deposits. Now, you're not exactly going to be shaking in your boots at the competition, but it is kind of a sign that we're heading toward that utility area. And anytime you have, for instance, regulators coming to you and saying, well, this area of the market is underserved, meaning low income mortgages or whatever, you got to go do something about that. That smells like a utility. Every time they say, we need to approve your dividend increases, that kind of sounds like utility. Do you feel like that's what's happening? Is that the mood in banking, that you guys are slowly being pushed that way?
I think the two issues you mentioned have actually been around so long that they haven't really come through in the market. There's certainly people that think that banks should become a utility, and the too big to fail concept sort of drives it a little bit that way. When you mentioned the post office, it's interesting. European system is often the postal service. That is the bank in a lot of the countries, or the primary postal savings is the term. If they're just taking deposits, that's kind of an interesting thing. So what are you going to do with that? I don't see the Postal Service making mortgage loans, but perhaps some politician does down the road. So the question then is, do you have to pay them to hold on to your deposits, which takes you back to 17th century banking. But the more regulation, and there's two sides to that. One, it locks a lot of other people out of our business. So in effect, we're talking about some crony capitalism there, that you have to have a banking license to compete. But by driving it more and more down the same path, I call it herding, where you have your cattle going right down into the chute. And I think it may actually increase the risk in the market by having everybody in the same businesses along the way. And it's the fatal conceit of a lot of different things. The Federal Reserve's fatal conceit is they feel that they can set interest rates because the 12 members that vote say so. The other fatal conceit is that a government can run an enterprise and foresee in advance all the different permutations of client interests, client desires, client service. And I think, for my 2 cents, the market does a great job of doing it. And if you allow the banks to compete, and if somebody fails, you let them fail, seems like to be the best model for me.
As you're talking, I just had a thought that maybe there's one good reason why they should get into this business and maybe even make mortgage loans, and that is the post office knows where people live. And with all that securitization going on, people had no idea whether the house existed or who was living where or whatever. Maybe that's their one advantage.
So I think it would be funny in that regard. I'm sure they would have to do a little different know your customer than we do. But it's one of the funny things. I'm sure everybody's seen The Big Short. The one thing I thought about when I was watching the movie was, and it really doesn't come out there, was that whole era was sloppy investing. Institutional managers, pension funds, city money didn't do the due diligence that those hedge fund managers went in and did. They didn't fly to the neighborhood and see if there were anybody living in the home. They didn't
drive-by appraisals.
This was it was bad. There was bad behavior on one side and sloppy investing on the other. And I don't think that side of the topic's brought up as much as it should be.
But they like to focus on evil, right?
Right.
That's more of a dramatic plot. But do you think that investing is less sloppy now? Because look at what's going on in high yield, for example. People trusting ETF liquidity and all that stuff. Is it just a different area now that we're being sloppy?
I think it is. Perhaps less institutional in this case. It's more retail. The broker says I've got a great high yield ETF fund, and high yield is kind of an oxymoron these days. But they have a high yield fund. Yeah, okay, I'll just go into it. And for me, you have to have a significant spread to go into those funds. You really do have to have enough interest rate plus default rate plus a lot of other pieces to make it make sense. And for my 2 cents, the spreads aren't there, and I think that's sloppy investing.
Right. One last word before I let you go. You did show a chart. It was actually a table, and you showed performance through the first month of 2016. It was looking pretty bad.
Mm-hmm.
It was looking very bad, and miraculously things turned around. So we thought high yield was going to hell. Basically, it came back. Oil wasn't looking good at all. Came back. What do you see for the back half of 2016?
I think it was a great chart, in it was New York Times chart, and they used the word, what do you do when your stocks are plummeting? 21 days into the new year, they were. Oil was down 30%, now it's up roughly 7%. The dollar index was up, now it's down. And I think in the back half of the year, as I mentioned in the talk, we think that the strong dollar trend that we've seen over the last 3 to 5 years, depending on how you measure it, is probably at its end. If the U.S. dollar had risen significantly, after Brexit, after some of the European troubles, after the terrorist attacks, I would still be on the strong dollar side, but it really is kind of stayed around the same area and actually gotten a little bit weaker. We see kind of continuing bumping along in the economy. We hear more talk now about an initial Federal Reserve interest rate rise. We're still probably betters that they're unlikely to occur this year. They're starting to be a little political, and does that make it feel like the administration's made more progress? So maybe they do one in September. I don't know. I'm always a cynic in that regard. But I think we'll have a bump along the economy. As somebody walked up to me here at the conference and said, God, what do you think? Everything is just so bad. It's not so bad. It's not great. It's kind of John Malden calls it a muddle-through economy. It's just kind of bumping along, but when I get in the airplane today, it's going to be full. The hotel here at the Fairmont's full and pretty pricey. People are going to restaurants. Things are happening. They're just not happening at the pace we've all gotten used to since the 1970s. And so I think we're going to continue to just sort of bump along and hope we obviously hope we do better. We're optimists at heart. But it's going to be kind of fair to middling, and we do think that the dollar will begin to decline over the next couple of years.
Yeah, you're so right. There's definitely a lot of bad things going on, really bad things going on. At the same time, I'm going to be sitting here all afternoon talking about it until the Scotch tasting starts at 7 o'clock.
Right.
Case.
Worst things have happened, right?
There's always something good.
And it is a bimodal economy. We understand that, but the whole top end is doing great. The middle class has had a rough 20 years, but it's not out. And as we noted in another paper, actually, while the middle class has declined, more of them have gone to the upper class than the lower, which is kind of an interesting way to look at it.
Horrible consequence, actually. Let's wrap it up here. EverBank is a leader in foreign currency CDs and that type of thing. Last year when we spoke, we were talking about the Australian dollar and how that was really popular. Maybe it'll get even more popular because of this rebound we're seeing in resources. But what's popular now? Are people coming to you and saying, "I need the Japanese yen"? It's an unlikely thing, but look at the strength. So what's going on?
The yen's been spectacular this year, and people don't like it. It's funny. We still like Australia. For the very long term, if Chuck Butler were sitting here, he would say you need to own the renminbi. Japanese yen, people are always very suspicious of. Why is it? We're on 25 years into a recession, depression. There's no sign of recovery. They're still pumping money into the economy. There's no hope, but the currency is very strong. But we would probably be focused on other places, more resource-bound: Canada, Australia, Norway, and of course China.
You think the rebound in the Canadian dollar is going to stick?
We think it will as the resource prices come up. And as I said, the U.S. is not drawing that big, booming, strong dollar as crisis hits anymore. And I think as a result
that the children are in charge of the printing press up here now.
I do. We worry about a lot of things. Just another thing to worry about. But until they get the printing press cranked up, we'll have to see. I think good price of nickel, oil, timber, and gold can cure a lot of ills.
Hide the sins, as Rick Rule likes to say. Compensate for other sins in the government budget. All right. Well, I've been speaking with Frank Trotter, the Vice President of EverBank Financial. The website is?
You'll guess it, www.everbank.com.
And you like to direct people towards the Daily Pfennig.
Yeah.
So where can we find
the
that?
Daily Pfennig actually has its own site at www.dailypfennig.com.
All right, definitely check that out and check back here for more interviews from the Sprott Natural Resource Symposium. Thanks for watching. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.